ETFs weren't built for retail. They're institutional trading tech. After 20 years in banking, including a decade at State Street, you get three things: why ETF exists, how Heartbeat trades legally purge gains at the US fund level, and a 4-point checklist to pick the right fund, so you avoid hidden cost. Disclaimer: this is financial education, not investment advice. To understand why you should own an ETF, you first have to understand the nightmare that created it. October the 19th, 1987, Black Monday. The Dow plunges over 22% in a single day. It was a structural failure in the market. When big funds tried to sell, the system froze, because there was no way to trade a whole basket of stocks at once, without crashing the price of every individual company. So the SEC demanded a market basket to act as a liquidity valve. Nathan Most reverse-engineered a solution based on commodity warehouse receipts. In 1993, State Street basically launched the first S&P ETF, called SPY. Not only does SPY still exist today, but it remains the largest and most liquid ETF in the world, trading nearly $30 billion every single day. But while SPY started as a way to trade the S&P 500, we need to clarify what ETF has become today. In its modern form, an ETF is no longer just a basket of stocks, it is a sophisticated technological wrapper designed to track any reference value, whether it's an index, commodity, Bitcoin, or even specialized volatility target. It's a delivery vehicle for market exposure that offers institutional-grade precision to anyone with a brokerage account. While you see a simple ticker symbol, the professional market sees a dynamic process called creation and redemption. This machine relies on authorized participants, or APs, giant investment banks like Goldman or JP Morgan. When a pension fund wants to move $100 million into the market, the AP buys the actual stocks and swaps them for the ETF share. This in-kind transfer means no cash changes hands between the fund and the bank, which shields the fund from the transaction costs and taxes that normally bleeds out traditional mutual funds. Let's get to a brilliant piece of tech. Now, look at this chart. Let's describe what's happening here. The blue line you see in the actual price is the price of the fund. It's a random fund we picked out here in the US. In the background, in green and red, are the daily fund flows, the actual shares being created or destroyed. Usually, these flows are relatively stable, oscillating around a quiet center. But look at the massive vertical spikes. They actually look like a medical EKG. In the industry, that's why we call them the heartbeat trade. In 20 years of banking, this is the visually most fascinating tax optimization I've ever seen. This is a deliberate institutional maneuver to wash unrealized capital gains out of the fund. Under US tax law, these in-kind swaps are taxable. Billion-dollar funds move massive amounts of stocks in and out over just 48 hours to reset their tax bases. When you buy an ETF, you're a passenger of a tax-optimized machine that was built for the most sophisticated investors. Now that you see the mechanics, we have to ask, why do the biggest players on earth rely so heavily on this specific technology? For the big guys, ETFs solve a billion-dollar problem of cash drag. Imagine you are a 250 million euro pension fund. If you hold just 4% in cash for daily operations, this is 10 million euros earning almost zero while market climbs. A 10% market jump means you lost 500,000 euros in performance. In my world, that is a fireable offense. The solution is cash equitization. They use ETF as a temporary park for the cash, to capture every cent of market return while remaining liquid enough to pay out pension. Statistics show that more than 70% of asset managers now use this strategy. We also see this in transition management. When a sovereign wealth fund fires one manager and hires another, they use ETF as a bridge to ensure they are never out of the market. ETFs aren't just an investment, they are the grease that allows the gears of global finance to turn without friction. Hey, if you want institutional testable processes without the hype, subscribe to the channel. But if this technology is so powerful for the elites, how does it translate to a personal portfolio that doesn't have billions of euros? For a long time, that kind of diversification and tax efficiency we just discussed was a walled garden. reserved only for the institutional trading desks. Today, the ETF has effectively industrialized wealth management for everyone else. It has turned what it used to be a high-stakes guessing game into a reliable utility. Think of it this way. Picking individual stocks is like trying to build your own car from scratch. You might build a Ferrari, but you are more likely to end up with something that doesn't even start. An ETF is like buying a ticket on a high-speed train that's already running. The data confirms this reality. The SPVA report consistently shows that over a 10-year period, nearly 95% of professional fund managers fail to beat the simple market index. If the professionals can't win the stock-picking game, the most rational move for any individual is to stop playing that game entirely and instead own the entire market through the most efficient infrastructure available. Owning the market is the goal. But not every ETF is a high-speed train. Some are more like a broken bus. And you need a way to tell the difference. Before you buy, you must execute institutional protocol. Here are the 4 metrics you need to check. First, assets under management, or AUM. Professionals generally don't touch a fund below 500 million euros. Below 100 million, a fund is often unprofitable for the bank. You're buying closure risk, the danger that the fund shuts down, forces you to sell, and triggers a massive unexpected tax bill. Second, the tracking difference, or TD. This is vital. Most people look at the TER, or expense ratio, but the TER is just a promised cost. Tracking difference is the delivered cost. It is the ETF's return minus the index return. Some ETFs actually beat their index, resulting in a negative tracking difference. This happens because the fund makes money by lending out its stocks to short sellers. If an ETF has a 0.1% fee, but makes 0.2% from lending, your actual cost is minus 0.1%. That is the number that actually determines your wealth. You can find the tracking difference on different platforms like just ETF or Morningstar or whatever you like. Third, implied liquidity. Stop looking at the daily trading volume of an ETF ticker on your screen. That only shows what has been traded, not what can be traded. Instead, look at 2 things: the total AUM of the fund and the liquidity of the index it tracks. If an ETF tracks the S&P 500, it's backed by the liquidity of the 500 largest company in the US. As long as the AUM is high enough to attract authorized participants, you will always be able to get in and out at a fair price. Fourth, physical replication. For your core long-term holdings, always prefer physical replication. Synthetic ETFs use derivatives and carry counterparty risk. The risk that banks on the other side of the trade fails, and in a crisis you want to own the actual shares, not the promise from a bank. Now that you know what to look for in an ETF, there's one more critical thing that depends entirely on where you live. The regulator has built a fence around you. If you're in Germany or UK or anywhere else, and try to buy the VOO, Vanguard's US listed S&P 500, your broker will block it. This is because US providers generally won't produce the EU required key information document. You must use UCITS equivalents. But here is the domicile secret, the domicile arbitrage. If you buy a US stock ETF domiciled in Luxembourg, the US government takes 30% of your dividends. If you choose Ireland, the tax drops to 15% because of the specific treaty they have. On a 100,000 euro portfolio with a 2% yield, choosing an Irish domiciled ETF instead of a Luxembourg one can be worth tens of thousands of euros in additional wealth over 20 years. And finally, from German euros, the Vorabpauschale is back. And in 2026 you will pay a small tax on deemed gains every January, currently in a range of around 30 to 35 euros per 10,000 euros in equity ETFs, depending on the official base interest. It's a minor drag, but Ireland domiciled funds remain your best mathematical bet for US exposure at least. Stop being the tourist in the financial markets. ETFs are not just products. They are the infrastructure of the global financial elite. Understand the heartbeat. Know you are using a tax-optimized machine in the US. Follow the protocol. Prioritize 500 million AUM and look at the tracking difference, not just the fees. Optimize domicile. Make sure your X exposure is running through Ireland at least. In 2026, boring is beautiful. Your discipline is your only true alpha. But here's the paradox. If ETFs are so technologically perfect and efficient, why do the world's most sophisticated billionaire family offices still hold individual stocks? That is exactly what we will deconstruct in video number 2. I'll see you there.